Welcome back, Business 163, Personal Finance. And as you already know, this third video in our module on insurance, well, if in the previous video we were talking about renter's insurance, well, then certainly the next topic is homeowners insurance. For many of us, if sometime in our life we will eventually transition from renting a house or an apartment to buying a house. And so the same applies, right? If you have stuff that you value, stuff that you want to protect, it's probably a good idea to consider upgrading to homeowners insurance. What does that cover? What does that all entail? We'll look at that as well as some examples of how to interpret your declaration page of your insurance to know exactly how your coverage works. So all of that in this video as we look at homeowners insurance. Alrighty, so again, for many of us, we've rented for a while and we finally got to the point where we can purchase our first home. And generally, homeowners, well, as you see in the picture there, generally homeowners own more stuff than renters do. You've got more stuff. And the property itself, the home itself, is often the largest single purchase that a person makes in their lifetime. Quite frankly, most of us are not going to buy a property, a home, all cash, which means that if you have a mortgage, you've got a mortgage lender, and that lender is going to require you to carry and purchase and maintain homeowners insurance during the life of the mortgage. And quite frankly, if you own a home, you have far more potential liability, exposure, and risk as a homeowner than you ever did as a renter. So it just makes sense. You're probably going to be required to carry it, so let's find out, how does homeowners insurance actually work? Well, in the Bay Area, let's give you some current numbers for homeowners insurance claims. Common in the Bay Area, folks, for a variety of reasons, they may experience water damage. And the average claim in the Bay Area for water damage is $10,852. That is a lot of money. Water is a wonderful, wonderful life-sustaining gift, and yet, used the wrong way, it really can cause a substantial amount of economic damage. You see the price of the average claim there. Well, for homeowners in the Bay Area, the average cost of theft or burglary, you see the numbers there, $37.97. Wind damage, $34.05. Other forms of physical damage, a little under $5,000. And if you are unfortunate enough to suffer a fire in your home, average cost of a fire claim, almost $80,000. So not only it may be required if you have a mortgage, it's really important for you to consider homeowners insurance, and homeowners insurance that will adequately cover your exposure. Now, you should know there are 6 common parts of any homeowners insurance policy. You see the types of coverage there. There is dwelling coverage, and that, of course, is the main home you live in. There is coverage for any other structures on the property, right? You may have the type of home that has a detached garage. It's not physically attached to the home, nevertheless, it's a structure on your property. Or you might have a barn, or a shed, or an au pair unit, or any other structure that's not the primary dwelling, will also typically have a type of coverage for other structures. Like renter's insurance, there is also personal property coverage for the stuff that's not the actual dwelling, but your stuff inside the home. There is also loss of use and personal liability coverage in homeowners insurance, and there is separate coverage for medical payments of others. Now, all of these things will vary based upon what you're required to cover, what you want to cover, what you feel you have to cover, and of course the price that you have to pay. So let's take a good hard look at a couple of examples. Here you see on this screen an example declaration page for an insurance policy. And if you look carefully at this slide, this is a coverage declaration issued by the Homes Are Us insurance company. You see in the upper left-hand corner the name of the insured, Penny Wise, who lives at 121 Happy Street in Norwich, New York, and her insurance agent, just down the street on 26 Fair Street, the Walter O. Rogers Insurance Company. Now, you can see the effective dates. That's the term of the policy. Term runs from July the 9th, 2013 to July the 9th, 2014. The location is, well, her mailing address, 121 Happy Street. That's the residence that's covered by this insurance policy. You can see then in section 1, the details of the property coverage. You see the limits of coverage given. Coverage A is dwelling coverage up to $179,000. Coverage B is other structures coverage up to $17,900. Her coverage C is personal property for $125,300, and loss of use coverage, coverage D, $53,700. And for each of those claims, for any peril, she has a $500 deductible. Remember, the deductible is the amount she has to pay before the coverage kicks in. Now, let's keep going. Section 2, one step below there, right, in the coverage there, you see coverage E, her personal liability coverage is $500,000 for each occurrence, and her medical payment to others is $5,000 for each person. So you see there, below that, the limits called out there for each of the different coverage types, as well as the total premiums that are charged for each of those coverages, and then the total policy premium. Now, notice that the term is for a full year. Now, here's the question. If Penny's house is completely destroyed by a covered peril, what is the maximum amount the insurance company will pay to replace the home? And you can see there, the limit given is $179,000. And that's the amount of coverage for complete destruction of the house by a covered peril. Okay, so that's how you interpret that. You can see that $179,000 in two different places. The limit given in the bottom section there, right, under coverage A, and also under the property coverages in section 1, $179,000. Here's another question. With the same declaration, the same coverage for the same insurance policy, if Penny pays her premiums monthly, what is the cost of this coverage in her monthly budget? Remember, we talked about monthly budgets, right? Well, here's the deal. You look at the total policy premium, $904. Remember, that's $895 plus $25,000 for her personal liability coverage, and she gets a $16 discount for having home alert protection, probably something like a alarm installed in the house, right? So she's paying $904 a year, and that's for a full year, so you divide that into monthly, and she pays $75.33 a month. All right, now, here's a next question. Which coverage types will require Penny to pay a deductible for a covered claim? Select all that apply. And, of course, the coverages are A, B, C, and D listed in Section 1 with a deductible. Okay, so deductibles apply to her dwelling, to other structures, to personal property loss, as well as loss of use. They do not apply to liability, personal liability, or medical payment to others. All right, that's how you interpret this policy. And then let's take a look at this last example. Hey, what happens if Penny's house is broken into while she's out of town and someone steals $7,000 worth of property? How much will Penny pay, and how much will the insurance company pay to replace the items? Now, so the first thing we need to look at is, okay, what is the maximum amount that the insurance company will pay to replace stolen property? You can see there, coverage C, personal property limit, $125,300. This is well under that, so all of her stuff is covered. However, you can see from Section 1, she has a $500 deductible. And that's why the solution to this question is Penny will pay $500, that's her deductible, for the covered claim, and then the insurance will kick in to pay for everything else that needs to be replaced, which totals up, in this case, to $6,500. So hopefully that gives you a little bit of insight by working through these examples when you purchase homeowners insurance, how you interpret the declaration that details out exactly what kinds of coverage and how much, and when does your deductible apply. So working through these examples gives you sort of how to interpret that document. Now, you saw the premium cost quoted in that declarations page. What are the kind of the things that affect the amount you have to pay annually, semi-annually, or monthly for your insurance premium to maintain that policy? Well, there's several things in a homeowner's policy that will be considered in determining your premium. First of all, the house you're buying, right? So what's the replacement cost? What's the age? What's the type of construction of your home? And the insurance company is going to use all of those details to estimate how much it's going to cost for them to offer you coverage if your property is damaged or destroyed. What's next? Well, how much deductible are you willing to take on? Do you want a $500 deductible? Or quite frankly, in order to save costs on the premium, are you willing to accept a higher level of deductible? You can see there the note. Increasing your deductible from $500 to $1,000 may save you as much as 25% of the overall cost of the homeowner's insurance policy. And then, of course, the question is, if you get $7,000 worth of stuff stolen, are you willing to pay a $1,000 deductible and then have your insurance kick in for the rest, right? So you can see here how the relationship between your level of deductible and how much the overall premium cost is. Here's another thing. Do you run a business out of your home? If so, that's going to affect your homeowner's insurance policy, right? As well as, hey, what's your marital status? Yep, married couples pay lower rates. Why is that? Is that some sort of a parochial preference for marriage as an institution that insurance companies have? No, it's because all of these determinations are based on actuarial statistical tables. Quite frankly, married couples tend to have less insurance claims. Married couples, for whatever several reasons, represent a lower risk group. Remember that whole idea of risk pooling? Yeah, that's why they have lower premiums. Other stuff. Hey, what's the condition of your roof when you purchase the property, right? Because quite frankly, a tile roof is going to be more resistant to fire than a wood shingle roof. You'll get lower premiums with a tile roof. What's your physical proximity to the fire department? Where's the nearest fire station? If you live very close to a fire station, guess what? Your premiums will be lower. And then, what's your previous claims history, if you have one? If you're the type of person who tends to make frequent insurance claims, statistically speaking, you'll continue to make insurance claims. You're a higher risk type of person, your premium is going to be higher. So again, as we think about your premium cost, remember the concept of risk pooling. The premiums of many low-risk policyholders pays the cost of the few high-risk policyholders who need to exercise insurance claims. That's the whole point, as you see it applied here, the idea of risk transference through risk pooling in homeowners insurance. As I said, for most of us who, when we end up buying a home, may end up buying it with a mortgage, we're going to be required to secure homeowners insurance for the life of the loan. Therefore, it really is useful for us to take a good hard look at this deck and understand exactly how our premiums are determined, who issues life homeowners insurance, and how these things, these different types of coverages work when we need to make a claim. Alrighty, I hope that's helpful. We'll see you in the next lecture.